Dear members, dear friends, welcome to our ATEL annual conference. Today, our association is celebrating its 28th anniversary. Therefore, I wanted to thank all our members, delegates, peers and followers for their support. The success of an association highly depends on the dynamism of its members. I wish you and me can attend many further meetings and anniversaries of ATEL. But today, let's focus on the agenda and the content of our event. As always, very diverse and comprehensive. I hope you will like it as we do. Before starting, I wanted to thank once again our 6 sponsors, Bearing Point, EY, ING, JP Morgan, Coupa Treasury and BNP Paribas Cash and Trade Finance. Now let's start with our first presentation by Bearing Point Luxembourg. We will have Jean-Pierre Legrand, local-led asset management and asset servicing, Erwin Timmerman, partner at Bearing Point Luxembourg, and Lida Palacios, senior management consultant in banking and capital market. They will talk and comment on important current issue, the impact of the energy crisis on corporate treasurers, banks and the fund industry. Guys, the floor is yours.
Hello, my name is Lida Palacios. I'm a senior manager at Bearing Point. Bearing Point is a management consulting company with a global footprint and almost 5,000 consultants. In Luxembourg, we are currently around 50 consultants.
Hello, my name is Jean-Pierre Legrand. I'm also senior manager at Bearing Point.
Hi, my name is Hurik. I am a partner at Bearing Point. Today we would like to talk about the impact of the current energy crisis on corporates, banks and the funds industry. Lida, maybe to set the scene, what is generally the impact of the energy crisis?
Well, after the relaxation of lockdown rules, we have been facing a new reality, fueled by increased demand. Based on COVID, companies are now facing 2 new dimensions to manage: shortage of labor and in some areas, and shortage of supply. Both combined are causing inflation. But it does not stop there, isn't it, Jean-Pierre?
Indeed, soon after the rebound of the economies, a second wave of shock was created by an energy crisis caused by the Russian invasion of Ukraine. In the 70s, the crisis was coming from the oil price. This time, the crisis is coming from the electricity price, which, following the increase of gas price, have set across Europe problems for companies and individuals to keep consuming. On top of this, because of the move to seek security in US assets, the economy is also confronted with important realignments in exchange rates. This makes the USD to gain value very fast and is creating concerns to a lot of countries. It could lead, among others, to debt problems and higher import prices that harm the economies overall. And of course, Eric, this is an impact on corporate treasurers.
Yes, indeed. In fact, the critical topics for the treasuries to focus on are the same topics as we had during COVID. So basically, treasuries that have implemented processes during the beginning of COVID and have lived these processes since should be well prepared for what is coming. Focus should thus remain on systems and processes improvements so that Treasury has timely, accurate and complete visibility over cash and liquidity across the company. Liquidity sources, whether bank credit, supply chain financing and or accessing capital markets, should be reviewed and diversified if possible. Efforts to improve cash flow forecasting should be redoubled. The current use and future potential of centralized cash and liquidity management on group levels, such as cash pooling, in-house banking and payments, and collection on behalf of group entities should also be reviewed. And finally, the importance of Treasury engaging with and influencing more directly the drivers of working capital, including accounts payable and receivables, sales and procurement, should be emphasized with senior manager. With greater influence on working capital, treasurers will also be in a better position to leverage supply chain financing opportunities. But Lida, there are of course also changes different from the COVID where we should focus on as corporate treasurer.
Yes, indeed. One new topic that must now be on the agenda of many treasuries is the entire topic of energy hedging. In the past, this was mainly done by big consumers like the airline industry, industries smelting and forging aluminium, and so on. This topic might now hit in industries where it was deemed unnecessary before. Given the current crisis, it's thus important to monitor more closely energy prices and the primary material important for your industrial activities. It is also important to monitor the credit risk of your suppliers, especially if energy dependent, and of your clients. Many analysts are saying a recession is coming in 2023. If it comes, it will lead to an increased risk of default. But Jean-Pierre, I suppose also the banks and the fund industry are impacted.
Yes, definitely. We are once again facing similar parameters that caused the 2008 subprime crisis. The interest rates increased, preventing some borrowers to reimburse their loans. But luckily, regulators have deployed mitigation barriers like Basel regulation and ECB stress test. This implies taking mitigation action that should prevent to face again big turmoil and the collapsing of the European financial market. The banks will first face a negative impact on their revenue. On the capital market side, experts expect a sharp decline in investment banking revenues due to increased caution among companies and investors. In addition to this, long-term investments made by banks will lead to negative revenue impact. The valuation of these long-term instruments is decreasing, leading to a negative P&L and additional capital requirement impact. Even if this might only have a temporary effect because of the pull and bear effect, the impact will not be fully mitigated. But Eric, the banks will hopefully also have benefits from the current situation.
Yes, as higher interest rates translate into better returns on loans. However, in Luxembourg, for example, about 2/3 of the volume is at fixed rates for contracts signed over the last 5 years, and only 1/3 at variable rates. Because of this large number of fixed rate loans, it will take some time to have a noticeable effect on the bank's bottom line. Banks will also have to better remunerate deposits. But when, in the negative interest rate context, it was a challenge for banks to capture their margin, now with positive rates, they should be able to first recover their margin. So the impact for the banks will be positive. These positive impacts will more than compensate the revenue loss on investment, especially as in more volatile environment, brokerage revenues increase as well. We are thus confronted with a mix of positive and negative impacts. Banks' behavior will be a good indicator of the state of the economy. If the banks begin to increase provision for defaulting, we'll have a strong signal that the entire economy could be impacted. But what about the funds industry, Lida?
Well, the last years, asset managers were focusing on decreasing as much as possible their cash balance to avoid negative impact on their performance. The low cash balance approach was more due to a negative performance impact than to a risk management consideration. Asset servicers and custodians were creating incentives to their clients to keep low balance. Now, we are back to a situation where custody banks will welcome cash balance as they will be able to recover their margin. To maximize their revenues, they will have to perform smart arbitrage between how to remunerate their balance to attract as much cash as possible while preserving treasury spread, how to avoid client cash cherry picking, which would lead to an opportunity loss and additional work because of the cash balance monitoring. And treasuries will have to preserve their rating while the market will present opportunities linked to volatility in a context of turmoil. And Herwig, I suppose for custodians is also not an easy walk in the park.
Indeed, custodians will have to redefine their cash remuneration strategy and propose solutions for excess cash management while avoiding cannibalization. Better cash remuneration should provide an incentive to asset managers to leave more cash on deposits. This is especially the case when they could be tempted to even more increase their cash balances to reduce their market exposure in a context of uncertainty. To induce behavior allowing asset managers to leave more cash on deposits, custodians will have to reactivate services and solutions that have been less or not more used during the last years, such as cash sweeping. So we can conclude that like any crisis, this crisis is not different. It brings a lot of challenges, but also many opportunities. We thank you for watching this and listening to this video.
Thank you.
Thank you.
Thanks a lot, Jean-Pierre, Herwig and Lida, for this interesting overview of the impact we are all facing. Now let's move to the second presentation by ING Luxembourg. Our speaker is Dave Sprite, business developer, Corp ID. He will talk about the operational KYC challenges, a very important topic as it remains burdensome and too manual. Dave, the floor is yours.
Thanks for inviting me for the yearly annual conference organized by the ATEL in Luxembourg. My name is Dave Spruit. I work for Corp ID. I would like to tell you via this presentation more about the operational KYC challenge. Later on, I will also tell you more about the solution Corp ID. Well, this picture says it all. When it's about KYC, know your customer, processing of documentation, this is how we all feel. We feel frustrated when we receive questions from financial institutions related to our company, but we also would like to do business as soon as possible. KYC in the news. Banks are investing heavily in new procedures and processes. This to comply with local and global regulations and to avoid fines. Corporates prefer to stay focused on doing international business. KYC processes are slowing them down. I have added some recent articles here. Well, one is related to digital identification, published in the Treasury magazine of ATEL itself. Another article is published by Finextra, where they also describe that the customer itself should be in the driver's seat when it's about KYC. And another article is related to the latest legislation in your country. Well, the most heard frustrations in the industry are the following: the duplication of data, where your company receives a lot of KYC questions from one and the same banks, and when they have answered all the questions, the process starts over again. But next to that, other banks where your company cooperates with also ask you to fulfill questionnaires and other questions related to your company. Second item, what we also heard as one of the most frustration is that companies itself does not have a central platform where they store all their corporate information, a kind of collaboration platform within the company. Third item is more related to the unclear requirements. Everything can be asked, and everything is also asked by financial institutions on cases where they learned from. Fortunately, we have to deal with requirements, and it's not legislation yet. So this is also the right moment to steer on optimization of your KYC processes. And fourth item is related to the data privacy requirements. We all would like to know when we share, for example, confidential information like passport copies of your board members, we always would like to know who's sending those passport copies towards which third party. You would like to stay in charge. You would like to have an overview of the total process. And this also to be and stay compliant with the global data protection regulations we have, for example, in Europe. Well, now it comes to the solution Corp ID. In 2020, we have, there was someone who had the idea to improve this whole process. This resulted in a more professional solution, which was backed by ING, backed and funded by ING. It's also a co-creation with more than 15 European corporates, based on the input of their treasurers. In 2021, Corp ID went live. We even also already received some recognition. We won some awards. In 2022, this year, our focus is on scaling the product. We are continuously improving the product with help of corporates. Next to that, we are also creating a KYC ecosystem together. Our goal is being the global KYC standard in the world. What is Corp ID? It's your environment, so it's not the ID that other third parties can extract data out of it without your consent. You are always in charge what you share with whom, and you even receive an audit flow related to that. Next to that, Corp ID stimulates collaboration within your company, but also it will also stimulate collaboration with your business partners. You will always stay in control of the data of your company. We also steer on the up-to-dateness of information via task cards. So for example, when you are going to open a new bank account or going to add a new legal entity, you are growing. Corp ID is then also steering on all the global needs with regard to the KYC processing, well, what can be asked by third parties in the market. And last but not least, Corp ID has also incorporated an access management. This means that when you are going to use Corp ID, we only need to know the first user of Corp ID. This user will get the admin and manager role rights, so he or she is able to upload and share information right away with any third party. There's no limitation. This specific person is also able to invite other colleagues of your company and is also able to give a different role or the same role to a colleague, but he or she can also give a different role to the colleague. For example, the observer role, which means that that specific person is only allowed to upload information and is not authorized to share your company information with any third party. This is mostly linked to your own proxy regulation you have within your company. How Corp ID improves your process? Well, here you see a visual of the current process when you do not work with Corp ID. You see a lot of process flows, documentation flows. And now I show you how Corp ID works. Corp ID is that environment where you store your data on a centralized platform, and via one press on the button you are able to share your documentation with any third party. I would also like to address that this is also a highly secured environment. It works via Microsoft Azure, where the server is also located in Western Europe. Well, now I would like to show you our product video. I hope this will also give you a good impression of the product itself.
Let us show you how we simplify the KYC process. Corp ID is a single digital vault to collect, organize, and track your KYC documents. It enables easy collaboration internally and externally with your business partners. You always remain in control of your information by giving consented access to your business partner, and they remain up to date with the latest information you publish. This is how it works. Let's take a look at the corporate side. You log in your web-based KYC environment. The Corp ID environment is secured by bank-grade encryption and two-factor authentication. Your first-time onboarding experience is fast-tracked by responding to a KYC request of one of your partners. You can also proactively start collecting relevant documents yourself. You can structure your information by building the corporate structure over time. Corp ID helps you visualize your corporate structure, making it easy to identify who ultimately owns or controls your organization. You can also add individuals and assign them to multiple roles and entities. This gives a clear overview of your key shareholders and directors. After you create the legal entities, we help you by recommending documents that most banks ask for. These are presented to you in the form of task cards. There are several options to upload your documents, drag and drop being one of the favorites. Corp ID enables collaboration with your internal colleagues by easily delegating tasks directly to them. You will be notified when these tasks have been completed. You can easily add new business partners. When the documents are ready to share, simply select which ones you want to share with your business partner. You always have a real-time overview of the status of your documents in the KYC process per business partner and get alerted when your business partner needs your attention. You get notified once all of the documents are verified. It is that simple. This is how Corp ID works for your bank. Banks can easily set up a new relation with a corporate client that needs to be reviewed. Banks have a clear overview of all corporates they have set up a relation with. In addition, the bank can ask for specific KYC-related documents within the tool, which makes it clear for the corporate what documents to upload. Your bank will receive an email and can easily check which documents have been shared. They can further ask questions or request for additional documents. This all can be done within Corp ID and without sending endless emails. Corp ID. KYC made simple.
I hope this product video gives you a good overview of the product. I also would like to add something, because there are also some other added values subject to the product Corp ID. Because next to that we are optimizing your KYC processing, there are some other added values. For example, When you start working with Corp ID, it also brings some more clarity and structure within your own company. Next to that, via Corp ID, you can digitalize, centralize, or even decentralize your treasury finance functions. That relates how you work within your company. And as said before, Corp ID is a highly secured platform where it's quite easy to share your information towards any third party. So there is no limitation. It's not needed that a third party that is requesting your company for information is a client of Corp ID. So there are no restrictions. Via Corp ID, you can always share information with any third party via a highly secured way. And fourth item, what I also would like to address here as an added value, is that Corp ID can also be used as your corporate housekeeping. Well, mostly we know companies have their own legal systems for that, internal legal systems. But because Corp ID is also steering on your company's information, there is already a lot of legal and compliance information in this product. Next to that, it's also quite easy to build and create an organizational structure via Corp ID. There's a nice organizational builder feature within this product incorporated. Well, some latest facts and figures. More than 500 corporate clients are nowadays already experiencing the added value of Corp ID. Those clients have already shared with more than 60 partners located in more than 14 countries. What is also good to know here is that it's not crucial that an external party that is requesting for your company information is already a client of Corp ID. With Corp ID, well, when you are a Corp ID user, you can share your information with any third party. But the focus of Corp ID is on process integration, API connections, and becoming the digital identity platform. Related to the process integration, for example, it will be possible for your company, if they already work with Microsoft Azure, for example, to create a single sign-on, so that an employee of your company can also sign in your business platform and also directly in Corp ID, so that it's not needed to sign in double. Next to that, I would like to address again that Corp ID is a web-based application, so it's not needed to implement this tool at all. Corp ID can be used right away by your company. We only need to know your first user, and via an activation flow, you will be onboarded, and this first user is also able to pre-fill already some information, but you can also wait till your bank requests via Corp ID for some information of your company. The product itself is also already API-proof. That means that we can also extract information out of external resources. Think, for example, about your local company registers. The idea is that Corp ID will also be able in the future, of course, always with your consent, that's quite crucial. There will be a possibility that Corp ID has as a solution that you can also pre-fill already information that is already published somewhere in the market. So think also about your signatories or your ultimate beneficiary ownership statements and information related to that, or other information that is already stored somewhere at an external source. Last but not least, Corp ID is also focusing on becoming the digital identity platform. Well, Corp ID says already that it relates to ID in the word itself, but our aim is also becoming the digital identity platform. This means that, nowadays we still have to upload documentation. Documentation also needs to be signed off by your authorized signatories. Well, we are already looking ahead. How can we digitalize it? How can we, for example, link to an external resource and create a digital identity and validation and authentication flow, so that it's not needed to sign off all the documentation again. But based on enough trustful resources, then the idea would be that you can also rely on the fact that that shared organizational chart is indeed the right and current one, and also that it has been validated also by your authorized persons of your company. Well, collaboration on the short term is key. Only together we can improve the KYC journey by shaping the areas of data taxonomy, authentication and identification, and the distribution of models and questionnaires. It's Corp ID's mission to elevate the industry's KYC burden. We are looking forward to collaborate with you. I would like to thank you for this opportunity to present something about the operational KYC challenge and a possible solution. If you would like to receive more information with regard to the product, or you would like to experience it right away, please contact me or one of my colleagues at Corp ID. Thanks.
Thanks today for this presentation and his insightful comments. Now I would like to invite Coupa Treasury to come, and Tamir Schaffer, Vice President Global Coupa Pay and Treasury Sales, will address an issue which is key these days, with all the uncertainties we are all facing. How do I get the best return from my company's liquidity without increasing the risk associated with our cash investments? Will be the subject we will present. Tamir, the floor is yours.
Newsflash! For the first time in more than 10 years, we are in an inflationary environment. For many companies, and specifically CFOs and treasurers like you, this may be the first time you are experiencing this in your role as an executive. Still, historically speaking, interest rates are near all-time lows, even if they have bottomed out already. Are you asking yourself, are there other methods for achieving a higher return on your cash and liquidity while still being on top of your working capital flexibility?
Hi, my name is Tamir Schaffer. I currently lead the global Treasury and Pay sales team for Coupa Software. You might be asking yourself, Coupa? What's Coupa Software? Well, if you'll give me a moment, I'm going to play a short video giving you an overview of exactly what Coupa Software is.
Business spend often happens in silos, leading to poor visibility, lack of control, and less than optimal spend decisions. Coupa's comprehensive and unified business spend management platform eliminates the traditional silos of spend and puts the user in the center of everything. A common, intuitive user interface gives users one place to easily handle all direct and indirect spend activities across procurement, invoicing, expenses, and payments. A unified, connected transactional core brings synergistic benefits like effortless matching of POs to invoices, instant reconciliation and automatic payments, and prescriptions to better control spend. Being comprehensive means addressing the needs of all users involved in business spend and sharing data seamlessly. With a complete view of spend analysis flags suspicious transactions and identifies opportunities to optimize spend categories through strategic sourcing. Sourcing events are seamlessly converted into contracts, which are then used to enforce contract compliance during the procurement process. Both goods and services can be procured in Coupa, with all details of contingent labor spend tracked. Treasury management balances liquidity and risk to optimize working capital. A comprehensive view of third-party risk and performance lets you take corrective, real-time action. Finally, inventory management lets you check availability of inventory during spend transactions. All built on a powerful cloud-native business spend management platform, made more valuable by Coupa's open architecture and a large and growing community of customers, suppliers, and partners. The collective data, wisdom, and spirit of this community enables collaboration opportunities like group sourcing. Coupa advantages instant savings from pre-negotiated rates with top suppliers and community intelligence, Coupa's unique AI-powered capabilities for instant prescriptive insights built on a platform processing trillions of dollars of cumulative spend. With the most comprehensive, unified capabilities and an unmatched community, Coupa's business spend management platform empowers companies to spend smarter and maximize the value of each dollar spent.
Well, that's nice, but you're probably saying to yourself, okay, but what does procurement have in common with treasury payments and interest rates? Good question, and I'll spend the majority of today's session on this very topic. But first, a little about me. Before coming to Coupa in 2018, I was a treasury practitioner. In fact, from 1999 to 2005, I led cash management and funding operations teams at Goldman Sachs. Then from 2005 to 2008, I did the same at a small company called Lehman Brothers. And I promise you, What happened to Lehman Brothers wasn't my fault. After Lehman, I became an advisor to treasurers and CFOs, teaching them how to build world-class treasury operations teams. And in late 2010, two partners and I launched a new consulting company called the Montauk Group, focused specifically on advising them on how to build world-class treasury organizations. And I'm thrilled to be here with you today in Luxembourg to discuss a topic that's near and dear to my heart, and probably something that most of you, if not all of you, think about every day. How do I get the best return for my company's liquidity without increasing the risk associated with our cash investments? To find the answer to that question, let's start by talking about silos in our organization. When thinking about running an efficient operation, even in the best of economic times, one thing that runs counter to most companies' ability to be efficient is that we have different silos in our organizations who are responsible for different things. This usually means that one particular area of a company is focused on what they do, having their own mandates and goals, without truly understanding the impact of their work and their processes on other parts of the organization. This ultimately amounts to a lack of communication, a lack of data visibility, and a lack of appreciation or urgency, especially when it comes to the impact on treasury operations. And since COVID began, the impact of silos has been further pronounced, as you can no longer go to the other side of the floor or to another floor in your building to discuss a problem or concern with someone face to face. When I think about our role in Treasury, timely data and information is critical to our success. Knowing about payments that need to go out or cash receipts that we are expecting to come in, these are the basic building blocks to what we do. We cannot build an accurate cash projection without timely data and information, even if the rest of our organizations do not understand this. In thinking about procurement and its impact to Treasury, let's look at a simplified process flow. In thinking about silos, let's look at the typical source-to-pay process flow that most organizations experience. Now, when your organization needs suppliers or vendors for a particular service or good, which is the part of the organization that starts looking for and identifying prospective suppliers and vendors, assesses their risk as partners, determines their payment terms, and ultimately contracts with them? Correct. It's the sourcing or procurement part of your organization. And once they've done that, now people within your organization can go ahead and start buying from those suppliers, and those suppliers will deliver those goods and services. Once those services and goods have been delivered, guess what? Suppliers now want to be paid for those goods and services. And so they'll typically submit an invoice so that they can be paid. And then someone will go ahead and pay that invoice. Now, which part of your organization is the one responsible for assessing and reviewing those invoices and ultimately paying your vendors and suppliers? You guessed right, it's the accounts payable part of the organization. But wait, there's still another part of the organization that's still the gatekeeper of your bank accounts and your cash, and of course, all payments that go out the door. Which part of the organization is that? That's us. Treasury. As we've discussed, procurement has a job to source and contract with new suppliers and vendors for a particular good or service and negotiate payment terms with them. Accounts payable gets involved to manage all of the invoices coming in and ensures that your important vendors and suppliers get paid for the goods and service they provide. And finally, and most importantly, Treasury is here as the gatekeeper of cash, the manager of bank accounts, the owner of cash projections and cash flow, the team that is working nonstop to protect the company from fraud, all while trying to improve the rate of return on the cash we have and the debt we borrow. I don't think we get paid enough for what we do. And so from this point forward in our presentation today, I will work to demonstrate for you how making sure that we as treasurers, cash managers, and CFOs are able to improve the cash-on-cash return for our companies, which includes educating the procurement and accounts payable parts of our organizations, so that our needs as treasurers and cash managers are also on the top of their mind. Let's take a situation where we are now the CFO of a new company that is focused on doing events and conferences for organizations like ATEL. Okay, in our fictitious organization, we have $10 million in cash in our bank accounts as we just got paid for running several events over the past 3 months. However, we now have to pay the suppliers and vendors who helped us run these events. Here are the three suppliers: Contingent Workforce Incorporated, Luxembourg Moving Truck Services, and Caroline's Party Supply. Contingent Workforce has sent us invoices totaling 3.5 million euros. Luxembourg Moving Truck Services has sent us invoices totaling 750,000 euros. And Caroline's Party Supply has sent us invoices totaling 290,000 euros. So in total, we have to pay 4,540,000 euros to these three suppliers. Now, before I continue, here's a question for the audience. We asked the following question to accounts payable directors of more than 100 of our clients. And here's the question. What is the standard payment terms that your organization has in place with your suppliers and vendors? In other words, how many days do you have between when you receive the goods and services and when you need to pay the vendor for those goods and services? Raise your hand if you think the majority of our clients' payment terms are net 30, meaning they have 30 days to pay. What about net 45? Okay, what about net 60? And what about something that's greater than 60 days? Well, actually, we learned that the average net payment terms are close to 45 days. So for those of you that put your hands up when I asked about net 45, you've all won a prize. Go see Caroline Lecoq from Coupa after this session, and she will take you through a full demo of our Coupa solution. Is your procurement team setting up standard payment terms with all of your vendors, let's say net 45 days? Is your accounts payable team aware of those payment terms of net 45 days with most or all of those vendors? And also, is your accounts payable team holding back from making invoice payments until they've reached the full payment term of net 45 days, or whatever standard terms you have, or at least the terms written on the invoice? Or is your AP team on a FIFO basis, first in and first out, meaning they're just paying the invoices as soon as the invoices come in? You know, a few months ago, I was presenting this session in Texas, and I was stopped by a treasurer who said to me, Tamir, this is ridiculous. All organizations are managing their accounts payable process based on payment terms. I didn't agree with him, so I asked the audience, is there anyone here who manages an accounts payable team? One person raised her hand, and I asked her, does your team manage to the payment terms that are on the invoice? And what do you think her answer was? Her answer was no, they don't. They pay as soon as they receive the invoices. The treasurer who asked the question was shocked. And so I ask you, is your procurement team establishing standard payment terms? Is your accounts payable team aware of those terms? And are they holding payments back until the full amount of time is reached before they make those payments? Imagine if the cost of capital of your company is 5% and your AP department paid invoices on day 15 instead of day 45. That's 30 days worth of 4.5 million euros of working capital lost. And at a rate of 5%, the actual cost to your company is more than 18,000 euros. That's in just 1 month. If you multiply that by 12 months, that's more than 220,000 euros that you paid for based on a 5% cost to capital rate. It's that simple for you and your company to generate savings. Simply ensure that procurement is setting up extended payment terms for your company and that your AP department is adhering to the payment terms on the invoices and not paying sooner than they have to. Now let's move to the second of the 4 tools we will discuss today, using credit cards as a form of payment. While most suppliers are paid using electronic transfers, there is a growing trend in the usage and acceptance of credit cards as a form of payment. Using cards as a form of payment provides 2 distinct benefits to the payer. First, banks and issuers that provide credit card programs will provide cash in the form of a rebate to companies who are paying via credit cards. That rebate can be anywhere from 15 to 100 basis points. As a company uses credit cards more and more as a form of payment, those rebates can stack up and become very beneficial very quickly. Second, the use of a credit card as a form of payment allows for an extension of working capital, similar to what we discussed with the first tool today. as typically credit card bills are received every 30 days, and then a company has another 15 to 20 days after receipt of the credit card bill to pay that bill. Two real strong benefits for using a card. Now, while you may think that your vendors do not accept credit cards or wouldn't accept credit cards as a form of payment, they just might, especially if you're not giving them a choice. Typically, smaller suppliers and one-time only suppliers will accept card as a form of payment. And a benefit to suppliers who accept card is that as soon as they receive the credit card information, they can swipe the card and the cash is in their bank account right away. Now, one way to get suppliers to accept card as a form of payment is to promise to pay them early. Let's say within 15 days of receipt of their invoice, instead of the typical 45-day payment terms that have been set up. In this way, it improves your supplier's working capital situation while your company still gets the benefit of the rebate from your bank or issuer. Plus, you still get the benefit of extended working capital in that you still have 15 to 20 days after you receive your credit card bill to pay your issuer or bank. Okay, now let's move to tool number 3. Tool number 3 is called early pay discounts. And the effective use of early pay discounts requires coordination between the 3 groups we've been talking about all along: procurement, accounts payable, and of course Treasury. Often, invoices will include an early payment discount offer. Let's say 2% if paid within 10 days. This means that if the invoice is paid within 10 days, the supplier will accept a discount of 2% of the total amount of that invoice. Now, if a company requires a lot of working capital and is short liquidity, paying 5% for that working capital only to get a 2% benefit on an early pay discount probably doesn't make a lot of sense. However, for a company that has lots of cash and they are not earning anything by leaving those funds at the bank, in fact, they may be paying the bank to leave the funds there, an early pay discount is a fantastic tool to create additional yield. In this case, 2% on any and every invoice that comes through. This, though, requires discipline and good communication. First, Treasury needs to make sure that AP is aware that they should be using early pay discounts for invoices that have that option. Also, if procurement is doing their job, standard payment terms will include an early pay discount option. Treasury should be making AP aware that the company has the liquidity, then AP needs to sort and manage their work to ensure that only those invoices that have the early payment discount option are paid early, while all other invoices are not paid until their full payment term is up. This is why a siloed organization can hold back a Treasury department from earning the highest yield on cash possible for the organization. And this is an opportunity for each person here to work with their procurement department and AP department to ensure an early pay discount review and payment mechanism is in place for every supplier and related invoice. Okay, let's move on to the 4th and final tool today, dynamic discounting. While similar to tool number 3 in early pay discounts, dynamic discounting is different. With dynamic discounting, the supplier has the capability to contact the customer, request immediate payment for a particular invoice, and in exchange will negotiate a bespoke discount for that invoice. Now, do you remember earlier when I mentioned that I was a partner at a consulting company? Well, there was one time early on in our company where we had just paid for a conference and we had to make payroll in less than 5 days. And one of our clients was late in paying us. We were terrified that we weren't going to have enough cash to make payroll later that week. And so we considered different options for raising capital. Do we borrow money from the bank? Well, we didn't want to do this at this stage because the borrowing costs were way too high for us. Do we borrow money from our personal credit cards? So my wife, who is a professional accountant, by the way, would have said, absolutely not. So we came up with another option. Let's offer one of our best customers a discount on 1 year's worth of invoices if they paid us immediately. We called up that customer, and after only a little bit of negotiation, we did settle on giving them a 20% discount for 1 year's worth of invoices in exchange for payment the next day. Now that did a few things. First, it settled our payroll issue, not only for that week, but for weeks to come. Also, it gave our customer a much higher rate of return than they would have received had they left cash at their bank. They effectively manufactured a 20% return on cash for paying us immediately. Through our solution, we see dynamic discounts often land at 5%. And remember those three suppliers we talked about earlier? One of them, Contingent Workforce Inc., they're the type of company that have cash outlays every week to pay for their contingent workers. However, they are not receiving cash for those workers from the customers they did events for 4 or 8 or even 12 weeks later. Having the ability to offer a customer a discount on invoices in order for a company like that to make their payroll can be a godsend. Have any of your suppliers or vendors come to you with a discount offer? If they did, would you accept? And what if they are a critical supplier to you? Of course you'd want to help them and support them. Dynamic discounting can be a win-win for everyone. And it's a method of manufacturing a return on cash that's otherwise nearly impossible to attain while still being risk-free. I mean, you're going to pay the invoice anyway. Why not get a return on it if you can? Okay, and that's it. 4 tools. Through today's session, I hope we have been able to demonstrate the benefits of how breaking through organizational silos can benefit you in your role as treasurer, cash manager, or CFO. By opening up communication, creating smart best practices, and sharing information between procurement, accounts payable, and treasury, your company can benefit greatly by improving its working capital and cash-on-cash return. Most of our customers use all of these tools as part of a well-rounded approach to managing their procurement and AP, while ensuring good treasury and cash management hygiene. Will you put one or more of these tools in place in your organization when you return to your office? I sure hope so. And in conclusion, I want to say thank you to the ATEL organization and to all of you for the opportunity to present today. I look forward to meeting many of you as well. And I'd also like to say thanks to my colleague, Caroline Lecoq, for ensuring we had this opportunity to present today. In representing all of my colleagues at Coupa Software, I say again, thank you and enjoy the conference.
Thanks, Samir, for this overview. Very interesting. Time to move to our next speaker, who comes very often to talk about cash management and trade finance issues. I will invite Bruno Melado from BNP Paribas to join. Bruno is Global Head of Payment and Receivables at BNP Paribas, Fortis in Belgium. He will talk about the developments in B2B payments and Swift Next strategy. Bruno, the floor is yours.
Hi, I'm Bruno Mellado from BNP Paribas, and today I want to speak to you about your B2B strategy and the vision of instant cross-border payments. Today, you are facing a lot of factors, macroeconomic factors, which are affecting your business. We're going through the shocks after COVID, the uncertainties around Ukraine and the impacts on the energy supplies, inflation. You've heard it all. At the end, I know you're very busy working on all those impacts and trying to figure out your cash positions, your hedging, your way to invest short-term, long-term. But at the same time, on the other side, we have actual trends and changes that is worth for you to consider to define the strategy along the other responsibilities that you have to follow for your business. From e-commerce and digitalization after COVID, which increased enormously the amount of online payments, for example, for business to consumers. Now the trend is coming to the business to business, where only 30% of payments are actually done digitally. There's something to do there. On your supply chain, you probably have to look at the sustainability of your suppliers, sometimes changing suppliers, but you may have to think about how to help them cope with the crisis and stay alive during this period. Fraud is always affecting us. This year, Europe will be spending probably 40 billion worth of fraud losses. It is still something in top of mind where making sure that you're paying for the right invoices or accepting the right payment instructions is key. And then we have regulation. BAL 3 for sure, but certainly e-invoicing is a regulation that we're following you and I will be introducing to you because that has a potential to help your business as well revise how you do things. And of course, payments. payments are getting more instant, more digital, and they have opportunities as well for you. Now, let me start by setting the context on the process end-to-end of your organization. Very macro, and it depends on what industry you're in. But basically, you have a procure-to-pay process, which starts with people ordering things, which can be commodities, which can be even hazelnuts for the Rocher chocolates that you eat end of the year. But nevertheless, they're always goods which are purchased, and at the end, your company receives invoices on which you have to pay, do the accounting, and follow through. That requires an end-to-end synchronization with your procurement. On the other side of the spectrum, you have your sales teams and marketing, which have great ideas, new ways to sell, new ways to augment those sales. But at the end, they end up finding a challenge to integrate a payment in the B2B space so that you can have that seamless experience of ordering, shipping, and receiving the payment all simultaneously. Those are two processes where you have a key role to play, as there are many changes and innovations in that area, using certainly new payment methods, virtual cards, but as well digitalizing the invoicing, being able to receive invoice data and execute the payments, or proposing deferred payment methods. There's always the factoring topics and the financing, but there's as well the purchasing of payment terms, which is a new trend in the market as well. On the other side, you have the way to sell. And there what we see is that 1 in 3 companies in Europe have a marketplace strategy, meaning how do I help my distributors, my clients, sell themselves to their own clients. And these marketplaces basically enable to have an electronic channel for some of your customers. Or 2 out of 3 corporates in Europe as well have an e-commerce strategy where when you're in the B2B space, when you sell online and you need to collect the payment, the methods are still today not instant and not cross-border as much as to allow for shipping to happen directly. If you know your client and you will give him credit terms, that's fine. But if you don't know your client, like for example, selling advanced lubricant oils for Formula 1 cars, and you have to sell these to people in faraway countries, you need to find a way to get the payment experience to a point where you can ship at the time of the request. I'll come to that later on international payments. And then, of course, buy now, pay later, which has arrived to consumers. On the B2B space, this is actually even a better option, given that you have data on businesses on which to provide guarantees that allow you to sell and collect at a later time. These evolutions help your suppliers, helps your clients, helps your colleagues. But they have to be looked at individually. And if I focus on the e-invoicing, I think this is the perfect excuse to open those processes and look at them. Basically, this is a regulation which is coming into Europe, and dates have been announced for B2B e-invoices to be dematerialized, to follow given standards that are set by the government, and to be in a position to receive them and issue them if you're a large corporation. It comes with requirements like storing those invoices, but it comes as well with benefits like better reconciliation, like better transparency on the information that is exchanged. It can allow to decrease fraud. It can allow you as well to review how you automate your internal processes. Now, what is the state of play of this regulation? Some countries have already implemented the government B2B invoices. Now, the new dates are for business to business of a certain size. And so you're going to have to receive those invoices, for example, in France, in Belgium, in Poland, Spain by 2024. And you're going to have to anticipate how to get yourself helped, as TMS and ERP providers are not likely to have these solutions themselves. So you're going to have to look for ways to automate this process to receive those invoices and to send them. Now, there are 2 models in Europe. One is the T model or Y model, which allows you to actually send the invoice to the government at the same time that you send it to your counterpart. Or you have the I model, like in Italy, which is simpler, which means that everything has to go through the government. And of course, let's say it, the government wants to have transparency on VAT. That's why they're doing this. But as well, it actually will have benefits to the way that information is exchanged with your counterparts. But it will require to put yourself in a situation to do that along the process. So my advice to you is, number one, try to use this to rethink those processes on how you pay and you get paid together with your partners in the organization. Try to address those pain points that already exist, and try to find the way that your clients or your suppliers need to adapt their client journey to make it a bit more seamless. As an example, when in one of these events, a treasurer told me, I'm fed up of receiving calls from my suppliers to know when my payment is, where the payment is. We came up with solutions to, for example, give an update on the tracking to those suppliers automatically through email. And now those suppliers are able to know where their payment is without calling Treasury. This kind of improvements are possible thanks to technology today, but as well they require to think about what you want to change in your organization. And of course, all of this while doing this environmentally friendly. E-invoices means less paper, of course. Now, what I want to share apart from e-invoices is how BNP Paribas is looking at international payments and the major evolutions that are taking place right now, where the ultimate objective is to make cross-border payments instant and frictionless. And that is possible. It's a road, it's a trajectory, and I want to explain you how this is going to happen. So number one, SWIFT has a strategy in which we are part of with the top major global banks as to how to actually modify the way that we do international payments. Of course, there's the Financial Stability Board and other regulators who want payments to be more competitive, more efficient, more transparent and cheaper. And to do that, we have an ambition to make them cross-border instant. That requires to have a common language between systems and to have rich data, which is able to happen with new formats and new standards, and to look at how to actually integrate this into new ways to pay, for example, towards wallets or to refund from marketplaces. So to be a bit more open to all the cases in which people, businesses are actually paying and getting paid. That strategy is voted and presented, and it leads to a solution which is proposed by SWIFT, which is called the Transaction Manager. This actually changes the paradigm of an international payment, where before, to pay to Germany in dollars, I had to do a banking transaction, so one leg from Europe to the US, in one bank, then from that US bank to another US bank, and then finally from that US bank to Germany to get to the account, which was just maybe 100 kilometers away. So that was 4 transactions that would lead to one payment. With Transaction Manager, the solution will actually orchestrate that payment experience to make it look like one payment. Of course, this is where new solutions are being proposed to make international payments instant. The Transaction Manager will actually enable that all these parties actually speak with the shortest amount of time to confirm, based on one key principle, which is to pre-validate those payments so that you don't send a payment if you know it's going to fail. If you need an extra data field or an extra requirement, you will know it up front. That's the whole principle. And what we're trying to achieve is to avoid fragmentation. There are about 50 new instant payment systems in the world, last time I counted. There are regional systems that are created as well, like in the Gulf, in Nordics. And these new systems everywhere will actually multiply the number of payment options. So the idea is to use Transaction Manager to give a same set of standards and interoperability rules that allows all these systems to speak the same language, apply the same rules, and at the end you don't have to worry whether you have to send it to that clearing or that clearing. Basically, you will be able to route it to the best combination of cost, transparency, flexibility. That's the whole idea of Transaction Manager. Now, let's just maybe demystify where international payments are today. And again, they should go to instant. But today, already with SWIFT GPI, which involves 80% of cross-border interbank flows, we actually managed to get payments in general to 1.5 hours of performance. That's the median. And about 40% of payments are actually done within less than 30 minutes, which is incredible. What is the reality is that the reason why the payments cannot go faster oftentimes is the regulations on currencies in some countries, additional compliance requirements, of course, and it is very clear because the corridors have a very different performance. If you send payments from North America to Europe, that can be up to 15 minutes. If you send payments from Europe to Asia, it can take about 8 hours. Of course, you have to mind the time zone difference, which is not always favorable. But this shows you that international payments have clearly improved. Now we can always go further. And to go further, I have to share with you something that is happening in the world right now, which is not very visible to you, but it is the migration of central banks from the old messaging systems called MT to the new messaging standards called AMX, which is at the end a much richer, more data-driven message, which will be exchanged between central banks, and which is the same. And which, by the way, it looks similar to the one we have in Europe on SEPA. It looks similar to the new instant payment schemes in most countries. And so the idea is to have a common language with common set of data that can actually allow for a payment to start as a cross-border payment to India, for example, but at the end to be going into the instant local payment system, which allows this to be a cross-border instant transaction within seconds. That can allow for e-commerce use cases, for example, as I was mentioning before, of someone far away who has to get paid and has to receive confirmation that the payment has been received before shipping the goods. So this is possible, but we start with this step of central banks, which to you is similar like having the optical cable deployed in your street. At that time, streets were opened. You wanted bandwidth for internet. Cables were laid out in the street, but you could not use it until you come to the point where you actually have to change your provider of connectivity, where you have to change your television to make the most use of it. So that's going to be the next phase. At this point, just remember that most central banks are changing the basics, are changing those major cables in the street. And that means that many countries have actually done it. For example, last week already South Africa went live with this. But in the coming month, you will see Europe going live, Canada going live with their new infrastructure, and other countries. That's the line that you see in there. And the UK will come next year as well with this, with CHAPS. And the US is likely to be in 2024, 25, which is a major clearing that will certainly finalize this move. The standards are changing at the same time. And these standards, CBPR Plus, will actually define how the message should be structured, where to put which data, what data is mandatory, which data can come later. But at the end, there's a deadline of 2025 to adopt these new standards all along banks and corporates. Now, what does it mean for you? That's the key question. So at this point, it doesn't mean anything to you. This is the plumbing being changed. What's important to know is that 2025, you're going to have to change your messaging. So our advice is not to wait till 2025, but start early enough. You will have to work with your TMS and ERP vendors to understand how the data will be structured. You have to look at your own supplier partner data to see what data you are missing. And you're going to have to get to a point where when messaging changes in 2025, this should actually work seamlessly for you. But that will require some work on your side. You need to know that. But at the end, the benefits will overcome the cost of it, which is the ability to speak the same language across different payment systems and to be able to reach to that cross-border instant experience that we think it's important for the economy to grow and for international payments to be part of that growth and evolution of your business. So thank you. That's what we wanted to share with you. If you have any questions, please feel free to ask them. I'll be available for you.
Thanks, Bruno, as we saw many changes arise. Now I'd like to invite EY Luxembourg and Iga Milanarczyk, Senior Manager, and Bader Lamamedi, Senior Tax Manager, to join us. They will present the recent tax and TP transfer pricing development in relation with the intra-group financing, a very important issue. As you know, tax issues are still key for treasurers and they need to be well prepared and updated. Guys, the floor is yours.
Good afternoon, everybody. My name is Iga Milanarczyk and I'm a Senior Manager in International Tax and Transaction Services Practice at EY Luxembourg. And together with my colleague Badr Lamamedi, a Senior Manager in our Transfer Pricing team, we are here to present you the latest tax and TP developments in relation with intragroup financing.
For our presentation, we prepared a mix of international and Luxembourg tax and TP developments that we consider as most relevant to you and your daily work. Hence, we will start with an overview of the most recent and also upcoming changes at international and European level, and then we will move on to more local updates. As you all know, the past few years have already brought us some unprecedented changes in the international and European tax landscape. The changes resulting from the OECD base erosion and profit shifting projects fundamentally reshaped the international tax system. The BEPS plan, composed of 15 actions addressing different topics, was largely endorsed by the EU, and most of the actions were adopted in form of EU directives that were subsequently implemented by all member states into the domestic laws, and consequently impacted us all directly. The OECD notably updated its TP guidelines with a new Chapter 10, focusing on intergroup financing transactions. With these new guidelines, the OECD put the emphasis on commercial rationality of intergroup financing transactions and outlined some welcome clarifications on how to document complex transactions such as financial guarantees and cash pooling transactions. Regulatory changes, such as the LIBOR discontinuation, have also affected intergroup treasury functions. MNEs will also have to consider how markets and governments will deal with the current international crisis. Ukraine, the energy crisis, inflation that has reached record values in most developed countries, climate change, and so on. We have seen the Fed and the Bank of England increase their benchmark rates significantly, and the ECB just announced a massive, unprecedented increase of 75 basis points to combat inflation. All of these will have a significant impact on intergroup treasury functions, and even more changes are to come. Many of these upcoming developments will be relevant for companies performing financing and treasury activities in Luxembourg. Let's look at the next slide for a timeline. The public country-by-country reporting directive was published on 1st December 21 in the official journal of the EU, and it entered into force on 21st December 21. Member states will have to transpose the directive into national legislation by 22 June 23 at the latest. In Luxembourg, we are still waiting for the text of the draft law. So far, we have no insights on when it can be published. Further to the publication of the OECD Inclusive Framework on BEPS Global Anti-Base Erosion Model Rules, Pillar 2, the EU Commission proposed on 22 December 21 a draft directive to implement Pillar 2 rules across EU member states.
On the same day, another draft directive was published, the so-called ANSHEL Directive, or ATAT3, which stands for the Anti-Tax Avoidance Directive. As you know, ATAT1 and ATAT2 directives were implemented in Luxembourg already and are in force since 2019 and 2020 respectively. ATAT3 is expected to be implemented by 30 June 2023 and to come into effect on 1st January 2024. On 11th May this year, the EU Commission issued another proposal for a directive to encourage companies to finance their investments through equity contributions rather than through debt financing. The so-called DEBRA directive will introduce an allowance for equity finance of the new investments to mitigate the debt bias. If approved, DEBRA should be implemented by end of next year and enter into force in member states as from 1st January 2024. Still this year, we expect to see a proposal on the ETR publication rules, which would impose on the large companies an annual disclosure of their effective tax rates, as well as we expect proposal of the draft Pillar 1 directive. In first quarter of the next year, A proposal for a common EU-wide system for providing withholding tax treaty relief at source on dividend or interest payments should be published. Finally, also next year, the EU Commission is committed to finally publish proposal for BFIT, or Business in Europe Framework for Business Taxation. BFIT will set out rules for a single corporate rule book for the EU, based on key features of a common tax base and the allocation of profits between member states. So definitely we will have more than enough topics to update you on for the few years to come. Let's look in more details at 4 developments that, in our view, will have the most significant impact on you and your business.
I'm going to speak in more details about public CBCR and OECD Pillar 1 and Pillar 2 projects. Although they do not cover specifically Treasury and intergroup transactions, they will have significant impact on your operations and the way businesses approach tax. The public CBCR directive requires both EU-based MNEs and non-EU-based MNEs doing business in the EU through a branch or a subsidiary with total consolidated revenues of more than 750 million euros to disclose publicly the income tax paid and other tax-related information, such as breakdown of profits, revenues, and employees per country. The first financial year of reporting on income tax information will be the year starting on or after 22 June 2024 at the latest. Such information needs to be disclosed for all 27 EU member states and all black and grey listed jurisdictions. Metrics for CBCR will play an important role in future tax rules, for instance in the context of BEPS 2.0. Going forward, CBCR will therefore be under scrutiny and will directly affect companies' tax positions. OECD BEPS 2.0 project is divided into 2 pillars. Pillar 1 addresses the allocation of taxing rights between jurisdictions and considers proposal for new profit allocation and nexus rules. Essentially, Pillar 1 addresses how to tax large multinational groups that generate profits in certain jurisdictions where they do not have a taxable presence under current international tax rules. It is expected that Pillar 1 will particularly affect M&A groups with annual turnover of at least 20 billion and profitability of more than 10%. Although the idea behind BEPS 2.0 was to address the tax challenges arising from digitalization of the economy, Pillar 2 has actually not much to do with digital economy. Pillar 2 aims at introducing global minimum level of tax of 15% for large M&A. It includes sets of rules allowing to reallocate taxing rights between the countries to achieve that minimum tax. The regime is intended to apply to M&A groups with global revenues exceeding 750 million euros. The rules are very complex, and we could probably spend the whole day going through them and not be finished. An important aspect of the global rules in a Luxembourg context is to which extent the pre-Pillar 2 losses carried forward can be utilized. However, the draft directive requires an unanimous decision for adoption for the finance ministers for all member states. During June Economic and Financial Affairs Council, ECOFIN, no consensus was reached. Actually, there is an informal meeting of ECOFIN held on 9 and 10 September. If the agreement is passed, we will for sure hear about it.
Moving on to the UNSHEL or ATAT-free directive, which targets companies with no or minimal substance in their country of incorporation. The draft directive includes 7-step substance test. First, the gateway test aims at identifying if entity is at risk. Some entities might be exempt because of their activity that is considered low risk. If entity is at risk and cannot request for an exemption in case of no reduction of tax liability of its beneficial owner, such entity is subject to a requirement to report in its tax return on its substance. What you look at in terms of substance is whether the entity has premises available for its exclusive use, whether the entity has at least one bank account in the European Union, and whether entity has at least one director or majority of the relevant employees being resident in the area close to the incorporation place. These are the cumulative criteria that need to be supported by appropriate documentation. If these are not met, the company will be presumed a shell entity. Such presumption can still be overturned either by establishing that the entity conducts a genuine economic activity or that the entity does not create a tax benefit. Shell company which fails to rebut the presumption will be denied tax residency by its country of incorporation. All will receive a tax residency certificate, but with an explicit statement that it fails the substance test. Other member states will disregard such shell company and will not grant the benefits under the relevant tax treaties and tax directives. Finally, DEBRA directive aims at neutralizing the preference of debt over equity tax-wise by featuring measures that incentivize equity funding, while at the same time further limits the deduction of borrowing costs. Directive provides for a tax-deductible allowance equal to the difference between the net equity at the end of the fiscal year compared with the net equity at the end of the previous year, multiplied by a notional interest rate. The rate would be the 10-year risk-free interest rate for the relevant currency, increased by a risk premium of 1% for the multinationals and 1.5% in case of small and medium enterprises.
Overall, companies are recommended to continuously monitor the developments and assess the impact of the proposed rules on their business. As it is certainly not the first time and will not be the last time you hear about these developments, experience has shown us that international initiatives sooner or later ultimately will make their way into domestic legislations, including Luxembourg tax law. And moving to Luxembourg, what is the main message we would like to pass today to you is that things have changed significantly. Unfortunately, taxpayers can no longer safely rely on their historic ways of operating. Due to the ongoing change in tax legislations, some structuring or instruments no longer work, and tax authorities are taking under scrutiny many structures. This is why it's crucial for your business to assess your current state of art and adapt where necessary. And by all means, have a robust documentation in place to support all the transactions.
We have summarized the most recent and, in our view, the most pertinent case law from the past year. On 31st March 2022, the Appeal Court confirmed the two decisions of the Administrative Tribunal and upheld the equity treatment of mandatorily redeemable preference shares, MRPS, issued by a Luxembourg company to its sole shareholder. While the court acknowledged that the MRPS had certain debt features, such as 10-year maturity, no voting rights except for the cases foreseen by the law, cumulative and preferred dividend of nearly 7%, it nevertheless rejected their classification as debt instrument. Considering the circumstances of issuance of the MRPS and the forms used, the court concluded that a requalification of the MRPS into debt instrument was not possible. The consequence for the taxpayer was denial of the deduction of the yield for income tax purposes and also denial of the deduction of the MRPS for net wealth tax purposes. The key takeaway for you from these judgments is that nowadays the courts would not only look at the characteristics of an instrument for its debt qualification, but would also examine the economic reality of the transaction. Hence, it is important to document the circumstances and business reasons behind any debt instruments that are more sophisticated than simple plain vanilla loans. On the same day, the Appeal Court confirmed that a contribution to account 115 cannot be taken into account for the purpose of determining the acquisition price of a holding in the share capital of a resident company. This is important in the context of a withholding tax exemption or dividend and capital gains exemption, whereby, based on the domestic rules, the qualifying shareholder needs to hold at least 10% in share capital or of a distributing company, or an acquisition price of at least euro 1.2 million. Hence, our recommendation here is to assess all the cases that you are aware of where the contributions to the account 115 have been made in the past, where the 10% threshold is not met. Finally, we would like to draw your attention to a series of cases concerning liability of the directors and managers of companies for unsettled tax liabilities. The Luxembourg tax authorities are making use of the possibility offered by the law to call in warranty these individuals to settle the company's outstanding tax debts. Personal liability of the legal representative may be engaged even if they are not directly in charge of the day-to-day management of taxes. There were more than 30 judgments handed down in 2021 on this specific topic. A majority of these cases concern unpaid withholding tax on salaries, but there are some that refer to income taxes as well. Hence, for those of you who are legal representatives of your companies, we strongly recommend to diligently follow the compliance with all tax payments, in particular in situations where you delegated handling of tax payments to another person. As Badr already mentioned, over past 1-2 years, we've witnessed increased scrutiny from the Luxembourg tax authorities. The amount of controversy cases has significantly increased compared to 5-10 years ago. Typical audit procedure starts with an information request list sent by the tax inspector in relation to a specific item. or for transfer pricing matters in relation to all available documentation. The letter will outline the requested documentation and information, as well as financial years under review. Typical time for response is between 2 to 4 weeks. If the answer is not satisfactory, an additional request for documentation and/or clarifications can be subsequently sent to taxpayer. Here the time for response is typically shorter and is around 2 weeks. In case the tax authorities would disagree with the taxpayer, they may adjust the taxable base and correct income taxes or net wealth tax for certain years. Taxpayer has up to 3 months to launch the controversy procedure in front of Chief Tax Officer of the relevant tax office, so préposé, or directly in front of the Director of the Tax Authorities. We have listed here the most relevant structures, items that tax authorities are currently questioning. In the past, many taxpayers were using foreign finance branches, in particular the US branches, for performing financing activities. The benefit was that assets and income attributable to such foreign PEs was exempt in Luxembourg and in many instances was not effectively taxed in the jurisdiction where the branch was established because that country did not recognize a permanent establishment on its territory while Luxembourg did. To tackle such double non-taxation, effective for financial years starting on or after 1st January 2019, the domestic definition of a PE was amended and expanded by an additional paragraph relating to the recognition of foreign PEs. According to the amended definition, the recognition of a PE in a treaty country is depending on the proof that the activity that is exercised in the other country constitutes an independent activity and represents a participation in the general economic life in that other country. Tax authorities may request a confirmation that the other country recognizes the existence of PE on its territory. With the change of law, we have seen a number of tax audits of the foreign branch structures. And while most of those structures have been already dismantled, the tax authorities continue to audit substance of the foreign branches for the years within the statute of limitations period, which is 5 years and in some cases can be extended to 10 years. Whether a PE exists or not is determined on a case-by-case analysis. The documentation and information requested by the tax authorities typically are minutes of the board of directors of the company resolving on the creation of the branch, detailed description of the activities of the branch and exact address of the branch, official confirmation from foreign tax authorities that the company's PE is taxable in a foreign state, or alternatively a copy of tax return together with the corresponding tax assessments. They also request a copy of the lease contract, names and addresses of the managers, copy of employment contracts of the employees of the branch, proof of opening of the bank account in the name of the branch, and finally opening and closing balance sheet of the branch for the relevant financial years. The takeaway point for you should be, in case you have or had a foreign finance branch in your structure, to be prepared to provide all those documents to the tax authorities upon request. Based on my experience, gathering such volume of information and data can be really burdensome. Hence, I strongly recommend thinking of building a defense file which will assemble all this information in an organized and comprehensive manner, so that if you ever receive such a request, you have it all ready.
In addition, with the introduction of Chapter 10 of the OECD guidelines, we also have seen a stronger focus of tax authorities on intergroup financing transactions, on commercial rationality, and on the characterization of debt instruments. In particular, we have seen multiple structures that involve income-sharing loans or profit-participating loans being questioned or challenged by tax authorities. ISL and PPL are type of instruments used to track income from source investments and that leave an arm's length margin at the level of Luxembourg intermediary company. It allows to track income that will typically be higher than debt market rates and repatriated towards funds, for instance. In the past, this type of instrument could be supported by a transfer pricing study documenting the margin. Now, we are seeing tax authorities challenging or questioning this approach and requesting documentation to support also the interest rate on the payable side. We are also seeing more and more requests from tax authorities on documentation of intergroup financing transactions, where they request to provide sometimes in very short deadlines TP benchmarking and TP reports supporting intergroup interest rates. Having documentation prepared beforehand is clearly key in being able to deal with these requests. And one new area of interest for tax authorities, for instance, are the interest-free loans where a deemed deduction is applied. Since the last couple of months, we have seen multiple challenges on structure involving long-term interest-free loans. Specifically, tax authorities are challenging the level of deduction, claiming that AFL with some specific features, such as repayment in kind, early repayment option for instance, for the lender, are economically closer to revolving credit facilities or short-term facilities, and we try to apply lower notional interest rates. This brings the question of how to deal with current market volatility today when it comes to determining the transfer pricing policy of intergroup financing transactions and anticipate future audits. We have witnessed an increase in market rates since the beginning of this year, and this will probably gather more pace in the upcoming months. That will affect the pricing of cash pooling and intergroup loans, and group will have to consider how this will impact intergroup treasury function and also revisit intergroup financing conditions to be in line with market rates and RMS standard. Thank you for listening and for your attention. We hope that these topics we choose were of interest to you and remain available for any question that you may have.
Thanks to again Bader for this review of key elements to keep in mind. Now let's invite our last speakers of the day from JP Morgan. Jeroen Koch, Head of Payments, and Elena Forrest, Executive Director, EMEA Treasury Services. They will talk about the marketplaces. It is important to collaborate as a sport team. The questions they will address: how to ensure Treasury are at the forefront of changing business models. Jeroen, Elena, the floor is yours.
So good afternoon, everyone. Welcome to ATEL's annual conference, where we will talk about all things marketplaces. Helena, thank you for joining me today on stage and to talk about all things marketplaces. Before we start, maybe you can briefly introduce yourself.
Thank you very much, Jeroen. Thank you for having me. Helena Forrest. So I'm responsible for the EMEA payments transformation and partnership strategy, and I'm also responsible for delivering our e-commerce and marketplace proposition for the region.
Great, thank you, and welcome to Luxembourg and to the online community of ATEL. It's a pleasure to have you here, and generally, before we start talking about the business side of things, and obviously your role of head of EMEA payment transformation and partnerships, let's start a little bit light and get to know you a little bit better by asking you, if you could be a movie character, which character would you be?
I think I would struggle, Jeroen, to settle just on one. It'll probably depend on the time of the day and the day of the week. It would probably have to be a mix of a couple of them. My first choice would be probably Mulan, born in the East with strong family values and beliefs, advocating change, and I'm a huge fan of martial arts. Second one would be probably the slightly aloof Inspector Gadget. Just because I feel I'm solving a lot of mysteries when it comes to my day-to-day job, and I love building gadgets. And a third one would have to be probably one of the female Marvels, just because probably all of us need a bit of magic and superpowers in our day-to-day life, juggling demands from family, job, and still trying to find some time for yourself.
That's very insightful, and I learned a lot already. But and that's really great. I appreciate that. So let's talk about business. Let's talk about marketplaces. On the surface, it looks like a very lean and scalable business model. That can be set up fairly easily, maybe even without inventory. When setting up a marketplace, what are the key elements that one should think of?
What we see is that a lot of the traditional e-commerce models are being replaced by much more complex and sophisticated marketplace constructs. And you see that both in the B2C segments as well as in the B2B industries as well. The reasons and the objectives of companies moving towards that business model vary, but there are a couple of very consistent elements that come as part of that construct, as well as opportunities and key benefits. Certainly in the last couple of years with the pandemic and just general economic disruptions, we have seen that well-established and well-designed marketplace models seem to be a lot more robust when it comes to these economic disruptions. Marketplaces are ultimately platforms that bring buyers and sellers much closer together. They eliminate some of the intermediaries, and if they're very well designed, they remove the friction between the interaction of the buyers and sellers. For a lot of companies, as they evolve their business models and move towards that construct, it opens up an opportunity for them to diversify their product and service offering, because in addition to what they have to bring to the table, they can curate or add complementary products and services. And that opens up and broadens the target market for them, makes it a lot more scalable and a lot more robust for the future. It really triggers kind of a rethinking of the entire traditional business model, because things move a lot faster when you build a digital marketplace platform. It's about 24/7 service. It's about cash ins and cash outs 24/7, potentially in different currencies across different regions and countries. So there's a lot more complexity in there. So the elements on the very high level seem to be relatively consistent. It's about catering for the pay-ins, managing the funds, catering for the payouts, and everything in between when it comes to KYC of sub-merchants and a number of value-added services that can be offered to both to the buyers and the sellers.
So if I understand you correctly, bringing those buyers and sellers together is actually a business activity. Can you elaborate a little bit on what the role of a treasurer is in all of this? Why would they need to engage early in this process?
Absolutely. Ultimately, I think when it comes to the marketplace business models, it almost blurs the lines between the business, finance, and treasury functions, because the objective should be the same, and the business objectives need to be aligned with the treasury processes and treasury tools in order to achieve that objective. Once you have selected who you're going to be targeting, what type of market and product mix will be part of that new marketplace construct, it's extremely important to think through the payments infrastructure that will be embedded into that new business construct. Which processes would have to change when it comes to real-time service, 24/7 payments. And treasurers are ultimately tasked with forecasting and really steering the pay-in and payout activities of an enterprise. So they're really in the best possible position to advise the business on how to change those processes and which tools to select to power that new business model, and which partners ultimately to select from the financial industry to help them on that journey to achieve the successful outcomes and targets that they set for themselves.
So you've obviously in your role seen a lot of companies going through this journey, but there's a lot of industries that are at the early stages of changing their respective business models. What would your advice be to the Treasury team, largely here in the audience, that are at the beginning of such a journey?
As you evolve your business model, it's very much a mindset change of an organization, as well as it is an evolution of technology. So as a business and treasury function, there's a need to almost let go of some of the long-standing attitudes and beliefs towards, for example, competition. How do you work with partners? And as well as internally, how do you work with the business as a treasurer? Ultimately, it's about this common objective in the business strategy, where payments needs to be a crucial part of that overall execution. So it's clearly understanding what the objectives are, thinking through how that would impact the overall model, the time frame in which you are looking to deliver this. How will you be assessing and selecting partners that you need in order to construct that new business model? Understanding the regulatory and legal requirements in the markets where you will operate. There are huge differences whether you choose to be a licensed marketplace or an unlicensed one, or you could potentially even get an agent exemption in some of the constructs. So all these points need to be thought through jointly between the business and the Treasury department. And then ultimately, that will then trigger the next steps in terms of selecting the right partner that will enable that platform and that seamless experience, and by bringing buyers and sellers closer together.
I get it. But let's get a little bit deeper on that. Yeah. So it sounds great from a conceptual level, but can we make it a little bit more real? Do you have a success story of a treasurer playing a critical role in the establishment of a marketplace? What can you share for the people that are in the audience today and go be there at their desk tomorrow? What can they learn from all of that?
Well, as JP Morgan Luxembourg specifically, we have a number of amazing client use cases and examples where we have been working with the largest licensed marketplaces for quite some time. So we're able to support them on their journey with a number of quite sophisticated wallet and payout capabilities and cater for their needs. We have also a very recent great success story in the US, where we have helped L'Oreal SalonCentric to launch a marketplace in a B2B space, whereby our client was looking to expand their offering for the long-established salons that were purchasing L'Oreal products, and have added a number of complementary products and services, from furniture to coffee machines and even software that salons might require as they're running their businesses. And we at JP Morgan have been able to support them and provide them with an end-to-end solution for their marketplace construct, which is unlicensed and required sponsorship, a sponsored account. We have provided that construct also with our merchant services capabilities on the pay-in side, again, wallet proposition and payout capabilities to embed these financial products fully into the marketplace proposition that they have successfully launched in the B2B space. But Jeroen, I know you're based in Luxembourg and you're very close to some of our mobility industry players. So maybe you can actually elaborate on the key use cases that we have in that space.
Yeah. And for those that are not familiar with that, but JP Morgan established a joint venture with the Volkswagen Group, where we purchased just under 75% of a payments entity that is supporting connected car payments and mobility industry, but essentially helping with the entire digitization of that industry, where a marketplace model is often one of the use cases. So to your point, that is a licensed entity, an EMI license here in Luxembourg, where we support a lot of use cases in that industry. And what you told me earlier resonates very well with me, because the most successful use cases so far, and it's still early days for that as an industry, were really where Treasury was working closely with the digitization teams and really try to kind of put their head around key considerations like the treatment of the money that is then in that EMI, in that license plate. Is it treated as cash, or is it treated as cash in transit? It's an element that is very, very important from a treasury and accounting perspective, but not necessarily on the forefront of the business teams and the digitization teams when they're trying to solution. So we are also in this industry indeed seeing a lot of those challenges. And to your point earlier, by working together, by collaborating with all the parties, the outcomes are of the best quality, I would say. Yeah.
That's
great. So thinking about broadly about the marketplaces we all use in our day-to-day uses. Yeah, the Amazons, Uber is essentially also a marketplace, Airbnb and everything. What sets the success stories there apart from the less successful ones that I'm sure have been out there as well?
I think all the companies that you've just mentioned, what they have succeeded is to deliver an exceptional world-class user and client experience. I think that is the main ingredient to their success story. They have really eliminated the friction between the buyer and the seller and made it extremely convenient to transact. And in order to achieve that best-in-class user and client experience, you need to choose the right partner with the best-in-class products and services from the financial perspective as well, to enable those flows between the buyer and the seller. So I would say this is one of the most crucial elements that will set apart the successful marketplace construct versus the less successful ones.
Thank you very much. That was very insightful. One final question for you. What is the main piece of advice that you would want to give the Treasury team here in the audience when, together with their business partners, are going on this journey?
If you read through some of the statistics, so 1 out of 5 companies in Europe is already on this journey in terms of transitioning into a marketplace business model. And we expect over the next 2 to 3 years, another 60% will embark on this journey. So it is happening. It is happening now. So my advice to treasurers would be to proactively explore with their business partners where you as a company stand with regards to that transition, and clearly align on key business objectives, the experiences that you would like to create for your buyers and the sellers, clearly understand the regional coverage and the aspiration where you would like to go in terms of regions and countries, because it has a lot of different implications when it comes to marketplace constructs and the legal and regulatory requirements, the licensing models that you could potentially enter into, considerations whether you would want to be in the flow of funds, for example, which could be a highly regulated activity, or whether you would prefer to choose a partner that could take on that responsibility and cater for those needs of your marketplace business model. There are options where you could select partners in the fintech industry, very much a one-stop shop experience, or you could potentially assemble it based on individual vertical propositions that you could find in the market. Or the other option would be to choose a bank that has developed that proposition and could support you end to end as well. I think it's a relatively complex undertaking, and that partnership between the business, treasury, and finance is crucial. And therefore, the choices of the partners that will support you is very important as well. It's aligning the business objectives with the tools and processes that are important from the treasury perspective, making sure that the implications on your working capital are clearly understood. The risks, for example, currency hedging, if you're expanding in multiple markets where buyers and sellers will be interacting with each other. To which degree could you easily integrate with your existing TMS and ERP systems? The effort on your side, both from IT and process integrations, should be a key consideration.
Great. Thank you so much. There was great insight. And thank you everyone for listening and all your attention. You heard it. Go out early, engage with your business, and be really proactive, even if it is a small part today. Looking at and hearing what we heard today, this will be a very growing business model. So get out there early and engage the right partners. Thank you very much for your time, everyone.
Thanks to Jeroen and Helena. Very important, as our role is also to partner with our affiliates and operations. Now it's time to close this annual virtual conference. Thanks for attending. Thanks to our 6 sponsors, JP Morgan, ING, BNP Paribas, EY, Coupa and Bearing Point for their great presentations. I wish you a very good day and hope to see you soon to one of our next events, like the Treasury Tech Day on the 24th of November in the afternoon. You are more than welcome. Cheers.